Well, it bothers me that people are very dangerous when they invest. This word "play the market," that's a dangerous term. But if you do some work, do some research, know what you own, look at the research, look at the balance sheet. If you could add 8 and 8, get fairly close to 16, you can find out this company has lots of debt, no cash, they're in trouble. You shouldn't own it. So a little bit of research. People are careful when they buy a refrigerator, careful when they take a vacation. And they'll put $5,000, $10,000 some stock to hear on the bus or to party. That's dangerous. Imagine if you were in a mall the last 50 years. You would have seen Gap when it was hot, you would have seen Limited when it was hot, you would have seen when it was not hot. You would have seen when they were starting, people weren't excited about Gap anymore. And then you do some research, say, well, gee, there's a lot of limited stores, but we're only at 20, they can go to 400. So you see a company, I did really well with Dunkin' Donuts, a local company. I did well with Stop and Shop. But people could see that this is really some people showing up, or I guess the Sunglass Hut, no one's there anymore. So I mean, that's research. That's fundamentals. Well, the way you beat the index is you avoid the stocks to go down. You avoid the steel companies and the oil companies and Sears and Penny and where the companies are deteriorated. I mean, companies are dynamic. Behind every stock, there's a company. These are not lottery tickets. So you're trying to find the companies within the S&P 500 that are doing better. They're going from crappy to semi-crappy to good. That might take a couple of years, or they're going to grow for a long time. And you're trying to avoid the companies that are going south. That's how you beat them. Or you find some companies outside the S&P 500 that are great companies. CarMax was not in the S&P 500. They went up 200-fold. There's a lot of companies that enter, and a lot of their great performances before they go in. When you sell your great companies and add to the losers, it's like watering the weeds and cutting the flowers. Well, obviously, the market's gone up tenfold since I stopped running Magellan. So you make more money on the upside. The market's going to be a lot higher in 10 years from now, 20 years from now, 30 years from now. Trying to predict the market is really a waste. I don't know what it's going to do. It can go down. When I ran Magellan, 13 years, it declined 10% or more, 9 times the market.
Wow.
I had a perfect record. I went down more than 10% every time. Whenever the market went down, I went down more. But over the long term, the upside is more than the downside. So you're going to say to yourself, do I need the money in the next month? Do I need the money in the next year? Do I have kids going to college? Do I have a wedding coming up? Then you're a bad investor. If you can keep putting money in, you have 5, 10, 15, 20, 25 year, you should do well. No, I saw the textile industry deteriorate. I was recommending all the stocks on the way down. I saw the shoe industry go away. Industries can go from terrific to terrible. There's a great expression in the textile industry that helped me a lot.
Textile industry, yeah.
It's always darkest before pitch black. Just when you think things are terrible, they get terrible squared. I mean, so just because industries are getting bad, that's not a reason to invest. Wait for things to get better. Because again, somebody might be involved in steel, they might be involved in coal, they might be involved in iron ore, they might be involved in plastics. They'll see aluminum pick up before I do. So that's a cyclical turnaround. That might last 2 or 3 years. You might see it way before Wall Street sees it.
Well, I think the advantage of putting money into a retirement fund, obviously a Fidelity fund I would prefer, but index fund, whatever it is, put some money aside. It's going to compound tax-free.
Yeah.
Start saving earlier. The numbers are amazing.
Compounding will do wonders for you, won't it?
But until you want to invest directly in individual stocks, start a paper portfolio. Say, I'm going to buy these 10 companies. And then write down in like 5 bullets why. What's the reason I bought those? And then keep checking a year later, what happened? Did they really keep growing, or did a competitor come along? Do a paper portfolio. And you can do exactly what I did with a real portfolio and find out, what am I good at? What am I bad at? Am I really good at turnarounds? Am I good at small growth companies? Maybe I pay too high for stocks. You can do this over 4 or 5 years and learn what's your skills, and then specialize that. I had to own thousands of companies. The average person, all you need is a few in your lifetime. The hedge funds that have been on the long side have done the best. I mean, they may have a little bit by being short, but being right on the long side. Because obviously, if you're right, you can make, and that's, I would say, when I ran Magellan, I might have been right 6 times out of 10. But if I'm right, I make a double or triple occasionally. It offsets the times you lose 30 or 40%. In fact, you could be right a third of the time as long as you have a lot of good results. So that's, when you're short, you can only make 90%. When you're long, you can make 10-fold or 5-fold. So I think long is the way to be. I think the market is fairly priced on what's happening right now. You have to say to yourself, is 5 years from now, 10 years from now, corporate profits have grown about 7 or 8% a year. That means they double, including dividends, but every 10 years, quadruple every 20, go up eightfold every 40. You know, so I think that's the kind of numbers you're interested in. That's better. A 10-year bond today is a little over 2%. So I think the stock market's the best place to be for the next 10, 20, 30 years. For the next 2 years, no idea. I've never known what the next 2 years are going to bring.